Peter Mcguire, CEO of XM.com. Usually we speak to him in Australia. He's right here in the studios. Peter, always a pleasure to see you.
Good morning, Ashu. Lovely to be here.
And I hope you travel more often. So,
Yes.
And you're here just at the appropriate time. I started to see coking coal prices go up to $190 US, and I think 250 Australian, and I believe that's the highest level in 20 months.
Yeah, phenomenal.
What's happening out there, Peter? Because people say there's no steel demand, and yet coking coal prices are behaving like there's no furnace.
There's no ceiling to the price.
Sure.
You know, it's around about 11% of our export market, 15% is iron ore, so it's a huge component and great for our GDP. But we've just seen it rally and rally so strongly, really over the last, say, 5 to 6 months. And I think it's probably a little bit ahead of itself. But, you know, when markets move like that, and it's not unusual, it's terribly oversold, sure, and then they bounce. And that's what we've experienced very much over that period of time. So where's the future and how high can they go? Well, I think they've probably got a little bit more momentum there, but it's hard to put a ceiling on it.
Is it possible, Peter, that we're in a scenario right now that in the last 2-3 years, many of the coking coal mines, the ones that were just at discovery phase, like Mozambique and some of these places, just don't have the money to run it? So you actually have a demand-supply imbalance in the sense that some of the weaker guys who got into the business because money was easy have actually kind of backed off.
Exactly right. And that's, you know, when you look at that model and you see it's very, very, very similar as what's happening with the crude market.
Sure.
So oversupply, then you get to a point in time that you haven't got the capex to spend on something, and Mozambique was an example. Those mature mines, or those mines that are operating, you know, it's sunshine every day for them because they've been able to take advantage of the pricing and been able to match the market, and they're proving to be very, very popular and profitable, of course.
So, Peter, that brings me to a bigger question as far as India is concerned, because India actually doesn't have coking coal. I mean, our coal quality is very, very poor. It's about, I think, 3,000 kilocal or whatever it is, but it certainly isn't coking coal. So we got to import this, and you can't really shut your furnace on and off.
That's right.
How difficult can it become for steel plants going into the next 6 to 12 months, and could some of them just shut down because they can't really pass on the price, but they're getting this huge upside on the raw material?
Yes, exactly right. Well, that's similar to what iron ore experienced over those, you know, the last decade. Those big price spots from $60, $70, all of a sudden it's $160, $170 a metric ton, and that just shows the volatility of the market. And there are players out there that have got to sit on the sidelines, or they may not be able to pass that price point on. If you look at the rig producers and what's happening there in the States, all those rigs shut. So there's the counter side of it. You know, you see how the small, nimble players can get beaten in a market and they can't compete. And that's very similar to what we're experiencing across any commodity complex.
Peter, I haven't seen coking coal prices this high, and crude oil not moving up.
You would have thought it'd drag it up.
And we are very close to that 54 technical level, which after which really there's a 60, 62 kind of a resistance.
That's
but your
right.
thoughts, could we see a significant upside in crude oil?
You know, first off, you've got, as far as capital expenditure, I was just seeing something this morning, you've got differing views. You've got the likes of Tillerman coming out from Mobil and saying, look, there's no problems and everything's fine. Then you've got the Saudis saying that there's going to be less supply, we're at a shortfall, the next couple of years are going to be very tight. Algeria proved one thing. We got some form of consolidation. The market's up 15% in the last probably bit over a month, or bit under a month, I should say. So it's proven that there is if you look at the Russias, you look at Saudis, and you look at what's happening across the envelope of them all, it's been profitable and it's been good for them. Is there more upside? Gee, that's a hard one, you know. You've also got to take into consideration that the US dollar's had a very nice rally to the upside. So I think at the present time, the jury's out. We're waiting to see what happens as far as OPEC and Vienna. In the meantime, I think it'll be range traded unless something dramatic happens as far as geopolitics or, of course, weather outages.
Sure. Peter, I was thinking more on the lines of what traders in New York are doing, and maybe traders at Goldman Sachs and T. Boone Pickens.
Yes.
Because you know, this market is also driven highly by the derivatives market, and I've started to see the long-term options in crude oil really starting to shoot up, or the premium starting to shoot up. Could that be indicating that maybe it's a pure trading play, and nobody knows whether 150 is the right price or the 50 is the right price? I mean, the Saudis have been producing at $8 right through.
Exactly.
So could we just have a trading uptick, not really driven by supply demand, with the guys sitting in New York?
Yeah, the hedge funds and so on. I mean, when you look at what the hedges have done, they've had four cyclical moves, and we're saying that this could be the fifth cycle. So those cycles that were incredible volatility swings, what we've experienced. You know, we used to see moves that'd take 6 to 8 weeks for a price spike. Now we're seeing it in a matter of days, and that really puts a lot of confusion to the market. And you've seen a lot of those big traders, and we're saying that the hedge funds are certainly moving, and they're far more bullish than they were. It was oversold probably going back a month and a half to 2 months ago, and since that period of time, it's rallied very strongly. I do take on board that the big boys certainly trade the market, and they've pushed it very, very well to the downside, and now we're being pushed to the upside. How much further? The jury's out on that one.
Well, Peter, we see you more often in India. So what are the prospects? Looks like there is significant investor interest in the market.
I think fundamentally, India, it always surprises me. It's such a vibrant nation. I don't see the storyline going away. I don't say that as in any form being patronising. I just mean it quite sincerely. You've got the demographics, you've got the population growth, you've got technology, infrastructure, and it's, in a lot of ways, the next matter of decades are certainly going to be India's. IMF numbers, forecasted growth. It's one-way traffic, and I think that you'll go through a couple of lumps and bumps on the way through, but the long-term prices are probably cheap where you're looking right now.
Sure. So, Peter, what do you think are the prospects for metals and mining stocks at the moment? Because surprisingly, the best performing indices in India have been the metals index, which is up 48%, and the commodity index, which is up 36%, way outperforming banking or whatever else.
Absolutely. And they pick everything else up. I mean, you've only got to see the likes of the BHPs and what's going on with Rio and, of course, Vale. And then when you look at the energy sector, that all coupled in, people are re-employing, people are deploying capital in the sense of, CapEx and new explorations and so on. That will drag the market up. The world, and my humble thoughts are that you certainly need stronger commodity pricing to make everything feel good. It does lift all boats, and as that tide comes forward, I think that will continue. So your mining sectors and the consumption patterns aren't going away. Concrete, steel, building. I mean, you've only got to look at the cranes in Mumbai. Have a look at the cranes across India and, of course, China and Southeast Asia. And to the Middle East. It doesn't stop, and there's a lot of work to do over the coming decades.
So I was looking at the geopolitical situation from your part of the world, and I've never seen a president publicly say that we don't want anything to do with the U.S. We're going to side with the Chinese, which is the Philippines. But if Philippines was not sitting where it's sitting, it wouldn't be as significant.
No,
but it was always a U.S. influence base, Australia, what have you.
Of course.
Now that equation starts to change, and I'm just wondering from the market's perspective, if it's going to become U.S. versus China, could we then significantly see more money flow into India? Because generally then people start to say, look, we really don't know what's the political environment.
It's a political hotspot, geopolitics, and that causes a level of uncertainty. Duarte is quite an interesting president in his own right. You talk to Filipinos on the street, and from Sydney to Abu Dhabi to anywhere that you meet them, and I haven't had one say, I don't like him. And they've all put a thumbs up and say, yeah, he's doing the right thing. So he's obviously got a strong groundswell. He's an interesting character in his own right. And what he does, if he does partner or does some more strategic ties with China, it certainly is going to impact the fabric of the relationship between the US. Where do they sit through it all? And I think that this is going to be a tumultuous time, considering we've got who's going to lead the US. And if it was Trump leading, that would really cause some concern. I think Hillary's, the jury's out yet. Obviously, she's favoured at the moment, but things can change quickly. So
just in the next 6 to 12 month scenario, Peter, do you expect markets across Asia or specifically India really rise about 20-30%? Could that be a reasonable?
Oh, I think that's a big number. You know, I mean, let's just see what happens. I think 17 is going to be a year of volatility. Right. You've got to worry where the US dollar trades, what's happening as far as valuations on US stocks. I mean, you live and breathe that. You'd have to say, are we overpriced? What's happening? Are we going to see a rate rise? Are we going to see what's happening in ECB? You know, the jury's out there as far as, you know, March. They certainly can't seem to get traction there or get any wonderful growth numbers. Sure. Japan's a worry as well. So we're going in such a unique environment as far as negative interest rates and many countries wanting to cut and stimulus. And now you've got a US that's saying, well, probably in December, how many do we ratchet up in 17? And all of this is going to play into the market. So if you could get 20 to 30% on India, I think that'd be an enormous year.